The second part of the question says that if we have 35% debt in the capital structure for the new line of business, in that case, compute the required rate of return. So again, the sequence of solving the question would be same. I request all of you to write down answer along with me. Step number 1, calculation of beta of asset or beta of unlevered equity. That is our first step, which we compute using the information of proxy firm. It has already been found by us 0.7840, so we need not to calculate again. It is 0.7840. So it is 0.7840. Step number 2, calculation of beta of levered equity. It means that the beta of equity applicable to X Limited for the capital structure having debt of 35%. So in that case, again, we will have working of the answer like this. I request all of you to write down answer along with me. Column number 1 will be source of finance. The second column will be weight or proportion. Third column will be beta, and the last column will be weight into beta. Source of finance, there are two sources of finance. One is equity, another is debt. The proportion in which we are raising the funds is 35% debt, so of course 65% is equity. Beta of levered equity is required to be found. Beta of debt is 0 in absence of any information. 0.35 into 0 will become 0. As far as the beta of the asset or beta of unlevered equity, that is simple weighted average, it is 0.7840. Then you make the backward working. This is 0.7840. And then beta of the levered equity will be found as balancing figure 0.784 divided by 0.65. This is the way we are required to find answer, 0.784 divided by 0.65. So 1.2062. That is the way beta of the levered equity will be calculated. So this is the way we compute the beta of the levered equity. This is the way this is calculated as balancing figure. And then, so this value is also found as balancing figure. Okay. Next. Step number 3. In that, calculation of weighted average cost of capital. In that, again, there are 3 workings to be made. Working note A, calculation of cost of equity, that is RF plus beta into RM minus RF. The risk-free rate of return is 10. Beta is 0.7840 into return on the market portfolio is 25%. The risk-free rate of return is 10%. 10 plus 0.7840 into 15. 0.784 into 15, that comes to 11.76. That is the way cost of equity is 21.76. Working note number 2, calculation of cost of debt financing, which we already have done it. That is 10% into 1 minus tax rate. Tax rate is provided to us as 0. So 10% into 1 minus 0 is 10%. This is, we already have done it. Last is calculation of weighted average cost of capital. In that, column number 1, source of finance. Second column is the weight or the proportion in which funds have been raised. Third is the cost of capital, weight into cost. There are two sources of finance, equity and debt. The proportion in which the funds have been raised is 0.65 and 0.35. Cost of equity has been found by us. It is, oh, sorry, there is a mistake on my end. Beta is 1.2062. 1.2062. 1.2062 into 15, that is 18.09. That is 28.09. That is the way the cost of equity is found. Cost of debt financing is 10%. And then simple weighted average value will be found. So 0.65 into 28.09, that is 18.26. The next one is 0.35 into 10. That is 3.5. So 18.26 plus 3.5, that is 21.76. That is the way the weighted average cost of capital or overall cost of capital is calculated. Please take down answer. A quick revision of the working that we have done, dear students. We understand that, say, whenever a company is going to enter into a new line of business, then in that case, whatever is the required rate of return from the existing line of the business, that cannot be used for the purpose of discounting the cash flow series for the new line of business. That is the first thing. Second thing that we understand, that we are required to take into account the proxy firm, a company which is already doing similar business in that line of business. That company will be taken as a base. Based on that, we will compute what is the required rate of return from the new line of business. That is what we understand. This concept is derived based on the concept of net operating income approach. Net operating income approach has two phases, no tax and tax information is given. Right now we are in a phase of no taxes. So what happens that with the increase in the debt financing, one, the company is getting advantage of lower cost of funds. However, on the other hand, cost of equity increases. So the advantage of the raising debt financing is compensated and the weighted average cost of capital is same as it was earlier. This is the concept that we have. Now we started with a question wherein we understand we have been provided that there is a company called X Limited which is entering into new line of business, that is manufacturing of the mobile phone. For that line of the business, we have been provided that say NOKIA company is a proxy firm. For the NOKIA company, two information have been given: proportion of the debt financing in the capital structure and second, equity beta. Taking this into account, we make the calculation of the beta of unlevered equity. That is, for this debt financing, this is the beta of equity. Then in that case, what would be the beta of equity had there been no debt financing? That is considered to be the beta of asset or that is considered as beta of unlevered equity. Dear students, if at all there are no taxes, then in that case the beta of the asset is calculated using simple weighted average method. So the proportion into beta of equity, sorry, proportion into weight, that is the way we make the calculation of answer. Second step is calculation of the beta of the levered equity for X limited, considering the capital structure that it is going to keep. It has been given to us that say we are going to keep 25% debt in capital structure, means 75% equity. We understand that so the beta of equity into weight of equity, that is the way weighted average answer is calculated. Beta of debt is assumed to be 0 in absence of any information. And based on that, so the beta of the levered equity is found as balancing figure 1.0453. Next is calculation of simple weighted average cost of capital, wherein you compute the cost of equity, you compute the cost of debt financing, then you compute the weighted average cost of capital. That is what we do. In second part of the question, exactly the same procedure is required to be repeated with no change, except there is a change in the value. That is, the debt financing is provided as 0.35. Accordingly, the beta of the equity is calculated. Then the weighted average cost of capital, calculating K, KD and WACC. This is the way we make the calculation of answer. Now friends, of course the answer is over. However, now I am making some conceptual explanation to you. So everybody is requested to properly understand the concept, that how the calculations are basically reflected in the working that we have made. Dear students, we are having basically the 4 capital structures. If at all there is a situation wherein there is no debt financing, then the beta of the equity is beta of unlevered equity 0.7840. We are going to keep 25% debt, then in that case what is the beta of levered equity is found by us. In case of 35%, again we have made similar calculation. The proxy firm has the beta of equity as 1.12 for debt financing of 1.12. So for debt financing of 30%. So these things are ready-made available with us. Based on that, I am giving some explanation. If at all you make the calculation of the cost of equity, then in that case it is RF plus beta into RM minus RF. This is the way the cost of equity is calculated. What is RF? RF is 10. What is beta? It is 0.784. What is RM? RM is 25. And what is RF? It is 10. This is the way we make the calculation of the cost of equity. So 15 into 0.784 is 11.76 plus 10. That comes to 21.76. As far as the weighted average cost of capital is concerned, it is calculated as simple weighted average. That is cost of equity into weight of equity. That is 21.76 into 1. Why? Because debt financing is 0. So plus cost of debt financing into 0. So it comes to, of course, 21.76% because it is an unlevered form. Now you introduce debt financing, yes. Beta of the equity increases, yes. So of course the cost of equity will also increase. That is 10 plus 1.0453 into 15 minus 10, that comes to 15. So 25 minus 10, that comes to 15. 15 into 1.0453 plus 10, that is 25.68. So 25.68 into 0.75 plus 10 into 0.25. That is the way answer is calculated. 25.68 into 0.75. 10 into 0.25 is 2.5. Overall it is again 21.76. This is the way we can see that when you increase the debt financing, at that time expectation of the equity shareholder increases. we understand that it increases. With that, so the cost of equity also increases. However, weighted average cost of capital is not changing. Why? Because we understand that whatever the advantage of raising the debt financing, having comparatively lower cost. Because what you have to understand, friends, that cost of equity is 21.76 right now when you don't have debt financing. You raise debt financing which is having comparatively lower cost. But with that, the cost of equity increases and advantage of raising the debt financing is compensated and weighted average cost of capital is same as it was earlier. Next, suppose there is 30% debt financing in capital structure. Then what will happen? 10 plus 1.12 into 15, 16.8 plus 10, that comes to 26.8. This is of course proxy form. So 26.8 into 0.70 plus 10 into 0.30. 26.8 into 0.7 plus 3, that comes to 21.76 once again. Same explanation is repeated, friends. Now I hope that everybody is able to understand it. Again, 10 plus 1.12 into 15. I'm sorry, 1.2062. 1.2062 into 15. That is 18.09 plus 10. So it is 28.09. 28.09 into 0.65 plus 10 into 0.35. That is again 21.76. What I want to tell you, friends, is that for every capital structure, weighted average cost of capital would be 21.76% only because of the concept like this. Now again I come across to a question like this from students, that sir, why do we do answer in the 3 steps? Can we compute the required rate of return of the proxy firm and then we do answer? Because whatever is the required rate of return of the proxy firm, the same would be the required rate of return from us. Can we do answer like this? Of course no, because institute wants you to make the calculation and show answer. Again the question from the students, that sir, is it fine if at all I calculate the beta of unlevered equity and using this I make the computation of the cost of equity which is the required rate of return? Can we do like this? Again the answer is no, because we understand that you are required to make the calculation and you are required to show the all presentation of the answer. That is the reason you are required to do working like that. And this diagram, I hope that you will be able to reconcile with the table that we have prepared. Now I am dictating a note to you to explain this concept. Right on first point. Whenever a company is entering into a new line of business, comma, in that case, it cannot have same required rate of return from new line of business as existing one. Full stop. Second point, pros and cons of new line of business are different from existing line of business. Full stop. Next point, we will take base of proxy firm. A company already doing business in that line of business will be taken as a base to compute required rate of return from new line of business. Full stop. Over here, we understand that whatever risk and opportunities that proxy entity has from new line of business are applicable to us also. Full stop. Fourth point, with introduction of debt financing, comma, beta of equity is affected and also cost of equity. Full stop. Hence, we will compute beta of unlevered equity using capital structure of proxy firm and beta of proxy firm. Full stop. With paragraph write down, beta of unlevered form is also called beta of asset, comma, it means overall risk of the business. Full stop. This is what we understand. Fifth point. Afterwards, taking into account capital structure of diversifying firm, comma, we compute a required rate of return from new line of business. Full stop. Next point. If there are no taxes, comma, in that case, beta of asset or beta of unlevered firm is calculated as under. So in that write-down formula, beta of asset is equal to beta of asset or beta of unlevered equity is equal to beta of levered equity into weight of equity plus beta of debt into weight of debt. With paragraph write down, beta of debt will be taken as 0, comma, in absence of an information. That is what we understand. Next point. If there are no taxes, comma, in that case, for any capital structure, always required rate of return will be same, because introduction of debt financing will give advantage of reducing cost of capital, comma, however, due to increase in cost of equity, advantage of raising debt financing is compensated. Full stop. In bracket write down here ROI, rate of interest, should be equal to RF, comma, that is beta of debt should be 0. This is for the small condition which usually gets fulfilled. In that case, we will find an answer like this.